Most investors believe that staying 100% all in invested is what provides the best returns over the long term. But that belief could be what is quietly killing your portfolio's performance. I'm going to show you how a simple cash allocation can actually increase long-term returns, not decrease them. And I'll give you a framework at the end that top hedge funds use to take this strategy and put it on steroids. I'm Joe Brown. I'm a former stockbroker, and I run Heresy Financial, where I help active investors reduce portfolio risk and increase long-term returns. And this right here, what we're talking about today, is one of the most common mistakes I see with portfolio allocation. We're gonna have to get a little bit nerdy today talking about math, because there are two different ways that people calculate portfolio returns, and one of them is just wrong. The first and most common way that people measure returns is something called average annual returns. This one is very simple, and that's why it's so deceptive, but it is wrong. Imagine you are taking a look at an asset and you see some years it goes up, some years it goes down, other years it goes up, other years it goes down. And so you get a collection of all of the years of performance from this asset, and you write them down on a list. Let's say you go up 10%, then down 12%, then up 20%, then down 15%, then up 8%, then down 5%, then up 15%, then down 20%. It seems logical that the way you should figure out what your total performance was is to take every single one of those years' performances, add them all up together, and just divide it by the number of years. And this is actually what most people do. Now, the reason why we think this would be correct is because this is the way that you find averages in other areas of life. So imagine you have a classroom with 20 kids in it, and you want to see what the average score was in that class. You're going to ask everybody what score they got. You're going to have some 70%, some 80%, some 90%, some 55%, and some 100%. Add them all up, divide by the number of students, and you will get an accurate average number of what the class performance was. That's how that works. The difference is that in the classroom, each student's performance does not influence the next student's performance. However, in the stock market, every year's end performance is where the next year begins from. And that's why we have to use a different calculation. This one is called compounded annual growth rate. In other words, CAGR. The compounded annual growth rate is a calculation that takes into account the fact that if I went from $100 to $110 in year one, then the next year I'm actually starting from $110. I'm not starting over from $100, which means if I go down, I'm going down from a higher number. And so then if I go down from 110 down to, let's say, 80, the next year when I go up, I'm not starting from 100 like I did initially. I'm only starting from 80. So we need a different calculation that takes into account the fact that every year's output is the following year's input. If this is completely confusing you, don't worry. I'm going to make it very easy to understand with a very simple demonstration here. We're going to use extreme numbers that rarely show up in markets just because it allows you to see it so clearly. Year one, we had a negative 50% performance. Year two, we had a positive 100% performance. From 50 to 100, that's plus 50. 50 on 50 is 100%. Negative 50% plus 100% positive equals a positive 50% performance. Now the last step is divide that by the number of years, which is 2, which means our average annual return was a positive 25%. Now, if you looked at any investment that put on a piece of marketing material in front of you and said, hey, we had an average annual return of 25%, you'd think that's a great investment. I would have made 25%, but you'd be wrong because you're just where you were at the beginning. You went down 50 and up 50. You're still at 100. You made $0, even though the average annual return was 25% positive. Now, just in case you think it's the order that matters here, it doesn't matter at all. I challenge you to do this as many times as you want with as many different figures in as many different orders as you want. It's not about the order. It's just about the fact that this calculation is wrong when you're trying to determine returns. Now we're going to see what the compounded annual growth rate says we had, which for those math nerds who are wondering, this is the actual equation, and the answer is 0%. Obviously, we didn't have a gain, we didn't have a loss. We started at 100, we ended at 100. the CAGR is 0. Now, I know everybody's probably sitting there wondering, what in the world does all this math have to do with a cash allocation increasing my returns? Because if you've been thinking through this at this point, you probably noticed, but wait, the only reason the average annual return doesn't actually equal the compounded annual growth rate is because you had to start over each year from the results of the prior year. But if I could just insert more cash at the end of year one in order to get back up to where I was before, well then I would be starting over from the initial number, which means the annual average return would have ended up being the compounded annual growth rate. If that doesn't make any sense, just imagine if the stock dropped 50% and you were able to put in 50 more bucks. Now you have 2 shares. It goes back up to 100. Your position now is worth $200 and your total investment is $150. $100 for the first share, $50 for the second share, $150 for your total investment with a $200 ending portfolio value means for those 2 years put together, your annual growth rate was 25%. And so you're probably sitting there thinking, hey, if I can just make sure that every year I start over from the same amount, then I actually get those returns. And while you can't do this in reality because you can never know the exact bottom, you can never know the exact top, and to be honest, you might run out of cash, we can use this twist to drastically increase our portfolio returns. And also, by the way, if you have cash on the sidelines waiting to deploy it so that you can always be restarting from the same level, then overall your portfolio returns would be impacted negatively because your cash itself is part of your portfolio not participating in those returns. So that's why there's a drag on cash that most people look at and they consider to be not worth it. Don't worry, we'll talk about it at the end. So if we have a tactical allocation of cash that we are using to deploy into our assets when those assets go down, this accomplishes a couple of things for us. Number one, it means we have reduced volatility. Number two, it means we have high returns. This is what a hypothetical performance difference would look like with a portfolio that is 100% invested versus a portfolio that is 90% invested plus 10% cash. You can see that in year one, the 100% invested portfolio did slightly outperform the portfolio that had cash, which makes sense because year one was an up year. But year two was a down year, which means that the portfolio that had cash didn't go down as much overall, which is why you actually want that cash drag sometimes. In other words, in down years, because it's a drag on the down. And so the 100% invested account ended up worse off than the account that had some cash. And by the way, in the simulation I ran to produce this chart, the cash allocation got invested at the halfway point down. So I wasn't coming up with a hypothetical situation that people would be perfectly timing the bottom, saying, okay, if it drops 20%, you invested some of your cash at 10% down. If it dropped 50% down, you invested your cash at 25% down. So I wasn't trying to show what would happen if you perfectly timed the bottom, just if you allocated your cash on the way down, on average in the middle of the way down. So year two, we can see the 90% invested account performed better, even with that first year included, than the 100% invested account. And as we move forward, the difference just grows larger and larger and larger because every single time the portfolios move down, the one with cash moves down less. And every single time the portfolios then move up, the portfolios with cash in them actually move up more because they were able to buy more shares on the way down. So the returns on the way up are actually amplified, which means that over the long term, you can see how much this difference compounds on itself over and over again to the point where that 90% invested account is nowhere near the 100% invested account. And the 100% invested account is barely above where it was at the end of year one. And so if you were just looking at the individual stock that this hypothetical person had invested in, the stock would look exactly like this 100% invested chart. In other words, it'd be volatile, but ultimately kind of moving sideways. But with a cash allocation and being able to buy more shares on the way down and then shed those shares on the way up to rebuild your cash position, you end up with a much larger portfolio, even though you didn't actually contribute any more to it. Now, if that wasn't good enough already, that a tactical cash allocation would allow you to decrease downside volatility and increase your total long-term returns, it gets better because having a cash allocation is what prevents you from getting forced out. When markets crash, it's because everybody is selling like crazy. And people don't sell like crazy when they are selling at a loss just because they want to. They're selling because they have to, because they get forced out, because they have margin calls, because they have bills, because they lost their jobs, and they have to get liquidity from wherever they can. That's what causes crashes. And so if you have cash, you don't have to be one of those people that gets forced out. You get to be one of the people that buys from the people that get forced out. So it allows you to stay invested at the very least so that you don't unnaturally interrupt that long-term compounding interest and get out at the bottom when everybody else is fire selling along with you. And at best, it allows you to actually drastically increase your long-term returns. Now, if you want to put this strategy on steroids, you do this not just with cash, but with a few other uncorrelated asset classes. You want gold, you want Bitcoin, you want real estate, you want cash, you want stocks. Because when you have multiple asset classes that are uncorrelated in their performance, it allows you to do this constantly between the asset classes. In other words, you can grow your portfolio value even if the assets themselves don't on net increase in value, even if you don't contribute, simply because you are rebalancing when the relative performance between the uncorrelated asset classes is extreme. An example of this is the recent sell-off in the S&P 500 during an insane bull market in gold. If you have gold right now and you have stocks, you are able to sell a little bit of your gold and buy a little bit more of stocks, which is helpful because in the last couple of years, there have been times like from August of 2020 through March of 2021 when gold was falling, yet stocks were rapidly rising, which would have been a time to sell some of your stocks and buy some gold. So you can see how rebalancing whenever there is relative outperformance or underperformance between your uncorrelated asset classes, it allows you to build up larger positions even if you're not putting more money in. As always, thanks so much for watching. Have a great day.